I'm not super big into technical analysis. I've studied it in the past, and I, can speak the lingo, so to speak, but I haven't ever really you know, done it a lot, which is why I brought on Cyril here, who has been trading for I think over a decade now. Correct me if I'm wrong, but
Yep.
been doing it for quite some time and have had some success with it. So let's just get started straight into what is technical analysis and why does it work?
Yeah. So, uh, little preface here. Technical analysis. You'll find a lot of people are really torn on that, right? There's people who swear it works. There's people who swear it doesn't. There's people who say it does, but only on like well-established, tokens or well-established deep liquidity markets. I kind of fall into that latter category. It's technical analysis works 90% of the time uh, on deep liquidity, right? If you can't really do it on a smaller token or something like that. But technical analysis, it is the act of performing financial analysis using patterns and indicators in market data to identify trends and make predictions. And we're going to go over a little bit about that today. Um, but before, so later I'm going to be doing a little bit of a screen share and kind of showing you guys and walking you through part of the process for that. But before we get into that, I want to talk a little bit about the mindset necessary to actually be successful with technical analysis. Um, a lot of us, when we first enter the market, we bring a lot of our own preconceptions to the table. If you at your core believe that, you're feeling bullish on the market, then you're going to wind up subconsciously skewing any data you look at to confirm your own hope, essentially. So the technical analysis is more than just reading charts. It's more than knowing what to flip and anticipating market trends. It is patience, it's discipline, and it's emotionless. When we allow emotions to affect our trading and our analysis, it causes us to make rash and poor decisions. So when you're looking at a potential trade, proper analysis pre-plans your course of action for two scenarios. Scenario one, you're correct. Scenario two, you're wrong. Because you can analyze all the trends and all the patterns as much as humanly possible, but things can still flip at a moment's notice. Big news could happen, and the best laid plans get thrown to the wind. So you must prepare for being wrong. If you perform your analysis and enter a trade with a plan for either outcome, you won't panic, because when you start panicking, emotions come into play. You'll be able to execute the appropriate plan for the situation. So, absolutely leave emotions out when you are performing technical analysis. So, that is a little warning there. And the the second most important thing is having discipline. A lot of people feel the urge, like when you're sitting there analyzing the markets, a lot of people will feel the urge to be in said market. One of the number one mistakes I see a lot of new traders make is they're always in the market. They always have a trade open. And while this may work for a little while, eventually it will bite you in the butt. If you calculate out a trade. You say, okay, I believe based off of the analysis I have performed, it is going to come down to this level. And nine times out of 10, I watch as traders will hop in before it even gets to that level. And then they experience drawdown where their trade goes into the red. And then they wind up closing, for a loss. And then sure enough, it winds up turning around and going back up at the level that they had originally calculated. I see a lot of that take place. So when you perform your technical analysis, have the discipline to wait, be patient, and then have the discipline to get back out. Take your profits, right? Properly deleverage your position, because if you the other pitfall I see a lot of newer traders make is, let's say they buy in early to a new launch or something like that, and it's going up and going up and going up, and they're 10x, 20x, 30x up. The One of the biggest pitfalls is I see them not sell. It is hard to take profit because you're fighting that, well, it's been going up. What if it keeps going up? I'm going to wind up missing out. You need to be okay with knowing that when you sell, it is still going to 2x from there. You need to be okay with that. Because remember, part of the trading is not trying to time the top, not trying to time the exact bottom. You want to capture that momentum. So, uh, having prefaced that, we're going to go ahead and I'm going to do a screen share. And I'm going to share. Oh, I see Austin's an expert in scenario two. I'm going to go ahead and share my screen here. And all right, we are live. So feel free to join my stream.
Yeah, we can
All
see
right,
it. Perfect.
you can. Awesome, awesome, perfect. So what I have in front of me is the Bitcoin chart, and I have three indicators, or well, I have two indicators here at the moment, but we're going to add a third one. But I wanted to leave that one off so you guys could see the process of it. So for those who are sitting here looking at my screen saying, "What the heck is that program?" It is called MetaTrader 4, and I'm going to type that in the chat there. So MetaTrader 4 is the program that I use to do a lot of my trading. Now, it is Forex trading, which is a little bit different from what most of you are going to be used to. But the principles of technical analysis will still be the same. So we're going to be utilizing this because the charting software for it is very powerful. Um, and as you will see here in a little bit. So, this program can be downloaded. Let me grab you guys a link for that real quick.
And real quick, while you're doing that, I do have a couple of questions. So, back at the
Absolutely.
beginning, you said technical analysis is mainly for stuff with deep liquidity, and I think that is very very important for people to understand. So, somebody just looking into this, what is deep liquidity? What kind of defines that, and what do you look for?
Absolutely. So, deep liquidity, when you are looking at, well, here, since I'm sharing my screen, I'll go ahead and bring it up and talk through it at the same time. We have our deck screener, right? Let's just go ahead and grab a random chart here. So deep liquidity, you can see over here, see the liquidity tab. You've got one, the WBNB with USDT. It has $162 million of liquidity. So this is something that you could actually perform technical analysis on because it has deep liquidity. You look at it and you say, okay, there's $81 million of pooled USDT in here. If there is a small amount of liquidity, anything, in my opinion, under $10 million, you're not going to be able to really perform technical analysis on it because you're in a situation where very small buys and sells can move the chart a lot. Or if you have a whale who decides to exit their bag, it will move the chart a lot, right? So the deeper the liquidity, ergo the more money that's in the liquidity pool, the less that's going to affect it, and the more you'll be able to have your proper overall trends. If that answers that question for you.
Yeah, that's perfect. And then the last question, I guess, before we get into more of like the strategies of it, is for somebody that's never seen a candlestick chart before, what the heck is a candle? Like what defines
Absolutely.
the opening, the closing, if it's a green or red candle or up or down? What all does that mean? And then the wicks in between, kind of all that stuff that's not necessarily um, common knowledge.
Absolutely. So for this, I'm going to go ahead and switch over to the 1 minute chart, and we'll be able to watch the candles in action this way. So a candle, when you are looking at a chart, whatever time frame you're looking at, each candle is equal to that much time. So if I switch to the 15-minute chart, this big bullish candle right here comprises 15 minutes of movement of buys and sells. If I switch to the 1 minute, each candle is worth 1 minute's worth of buys and sells on the order book, right? So a candle, you have, let me bring up my pointer. Can you see my pointer all right?
Yep.
Cool. So a candle, it has an open price, which is where the box begins. It has a close price, which is where the box ends. Any movement outside of the open and close is a wick. If a candle is bullish, that means the open price was lower than the close price. It closed higher than it opened, ergo, it was going up. If it is bearish, it opened higher than it closed. Now we're going to look at this bearish candle here with a tall wick on either side, and I'm going to explain kind of what happened with that. So it opened right here at the top of the box. Price went up to here, hence the wick on top. Price came down to here, but then came back up and closed here. But it still closed lower than it opened. And that is how you read a candle. You can get a lot of information out of a candle. As example, let's take this tall candle here that has no wicks whatsoever. This is a candle of high momentum. It contains essentially nothing but buys. It opened really, low. There's no wick beneath it, so it didn't wick down at all. It opened and then closed high. So there's a lot of momentum here. That indicates to us that it's still going up. Then you have the next candle that opened, went up, 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 and then pulled down a bit, but still closed as a bullish candle. This indicates, okay, we're starting to see some selling pressure. Down here, you got lots of little candles with not really much in the way of wicks. A lot of buy pressure coming in, but then everyone started buying. And then people who bought down here are like, okay, I'm going to start taking profits because they're smart traders. They saw that it broke above their indicators. And so they started buying down here to position themselves. And then they started selling in this region. And so we have another bullish run. These are people who essentially caught FOMO, which is what you avoid by doing technical analysis. You don't start seeing, oh, it's running, running, running. I'm going to buy. And then you get left as everyone else exits, right? That's why a lot of people wind up buying high and selling low. They allow their emotions to get in place instead of positioning themselves down here after seeing it broke a level and was going to continue upwards. They're buying after it's already running, right? And so when everyone else down here has started selling, see the wicks, they're still buying, and then they wind up getting left holding the bag. And you can see right here, see how you have all of these wicks right here at the top? That's a lot of pressure that's coming and pushing it down. So if you did buy in down here, you can read the candles to see, okay, there's a lot of pressure coming in. I'm going to go ahead and exit. and then ta-da, you got out at that local top. So knowing how to read a candle is very important. And does anyone, before I continue, have any questions regarding reading a candle?
Think that covers it pretty well. The only other question that I could think of is that if you go back to the chart, you see there's that one gap candle, the huge bullish one at the start of the run, and then it kind of gaps up. Um,
Yeah,
what makes that gap? Because from the way that you just explained it, there's not really anything saying why something would have a big gap like that. So
right. That's a very good question. And gaps is actually something that traders will look for. And I'm going to show you what happens with gap. We're going to look right here. Oop, sorry, a little tricky on the laptop. Oh, that's why, because it's set to automatically push me at the end. There we go. Alrighty. So gaps occur in charts sometimes, and what that means is that nobody was willing to sell their Bitcoin at anything in this range. The first available Bitcoin for sale was being sold for this price. So someone who wanted to buy, they had to buy it at that price. And you'll see that happen a lot with Bitcoin because Bitcoin, there's so few of them actually in circulation that are available on exchanges for purchases. A lot of the volume that makes up Bitcoin is the same Bitcoin, handful of Bitcoin being bought and sold back and forth constantly throughout the entire day. So people were buying. It looks like okay, we had a. This is what's known as a bullish engulfing candle, where the bullish candle is taller than the bearish candle right before it. So people are like, all right, cool, it's going up. And people are like, I'm going to list my Bitcoin for sale for this price. So when people bought up all the ones that were available in this price range, the next one that sold had to be sold at this higher price. So that's where it will print the next candle. Now, the way the charts will interact when there is a gap, 99.9% of the time, it will look to fill that gap. And what that means is if you have a gap while it's going up, it is going to try to come back down until it at least comes back down to close the gap. So if your gap was from 23,682, the price is going to try to come back down to that level to fill the gap. And that's what we actually see happening right now. It is working its way down to fill this gap. That make sense?
yeah, yeah, I've heard that before when looking into technical analysis and doing all the research on it. Um, like I guess the last question before we can move forward into like how we actually apply what we just learned as far as reading a candlestick chart into actually making a strategy and playing based off of that. Is there a fundamental reason on why that gap gets filled? Because at the end of the day, people click the buy button and people click the sell button. Is there something that like I guess a greater reason why it would go back down to that gap or go up back up to that gap if it were a gap down?
So a lot of it winds up being due to a self-fulfilling prophecy, right? People expect it to go down to that level because there was a gap there, because in the past they've seen it do that. And as a result, they'll start taking their profits, they'll hold off on buying, looking at that as a potential entry position, right? So a lot of technical analysis winds up becoming self-fulfilling prophecies. If everyone is trading based off of Fibonacci's, then Fibonacci's are going to self-fulfill their own prophecy. If everyone is trading off a trend line, then the trend lines will self-fulfill their own prophecy. And some of that has to do with the way the big money interacts with the market. They use a lot of bots and algorithm trading that are designed around the Fibonacci or designed around the moving averages. And big money is what moves the market, right? So we look at the patterns of how the market moves, and it's moved by the big money. which is using algorithm bots to trade based off of this information, whether it's the Fibonacci or the moving averages. And so then we start using that so that we can trade with the big money, because you will lose every time if you trade against the big money. And so that the art of technical analysis essentially boils down to, we are trying to copy the big money. And the big money is utilizing several key indicators. And so, ergo, we use those indicators so we know when they're buying and selling. And that leads to a higher success rate. But it is still important to utilize risk management, even if you believe you are trading with the algorithms and with the big money. Because if you use proper risk management, you can lose 60% of your trades. But if you're managing the risk exposure, the risk to reward ratio, that 40% of your wins can more than cover whatever you may have lost on the trades you were wrong with. So, but risk management is a whole nother topic, and maybe we will have some time to get to that today, hopefully, but we will see. There's always time for another class at a later point.
Yeah.
Um, So moving forward, if you guys are following along and you download the Hugo's Way app and you look at it and you're like, oh my gosh, this looks nothing like what I see on your screen, that's understandable. For what you can do for that is you'd click on charts, go to properties, and you can set all of your colors, right? And I'm going to go ahead and drop a little screenshot for you in the chat, so that if you're wanting to copy my visibility settings, you can. 'Cause I think it starts off with like a black background and green candles that don't have like bars or anything. Um, my I selected at the top here, draw a little arrow. That's what this is, the option that you want for your candles, right? Otherwise, I believe by default it starts off like this, which tells you the same information as a candle, but it's not as easy on the eyes, right? So we're going to be using candlesticks. Candlesticks was actually invented by an individual to track the price of rice, um, trading way long ago, and they actually wrote a book called the Candlestick Bible, and it's been translated and passed down, etc. If you ever get a chance, it's a good read, and maybe I'll share a link to that at the end. All right, so let's get our indicators set up. I only use 3 indicators, and all 3 of them are the exact same thing. So, what we do is we go to chart, uh, indicator list. Oh, not indicator list. Sorry, I usually do this from my phone. So, where is insert indicator? Give me one. Here we go. So you go to the insert tab, indicators, and oh, there you got to see it. That gap just filled. Live action. All right. Oh, look at it go. All right. So indicators, trend, moving average. Um, where it says period, I'm going to be adding the last one. So that's period 200. We're going to change the color to pink. No shift, simple moving average, apply to close. And then it adds a little fancy line here. So the blue one is period 50. That's all you got to do. You just put in period 50, change the color to blue. Orange one, period 100. Pink one, period 200. And I'm going to type that here for you. Blue, period 50. Orange, period 100. Pink, period 200. But yeah. Um, then you will have, we're going to switch off the minute chart because that makes that candle look a lot scarier than it does. And I think that's going to wind up getting more attention than you listening to the lesson. But all right. So let's zoom out a little bit. And it's all right. I told my brother yesterday, while it was chilling up here, that we were going to be seeing this region today, the 22.5K region. So this was expected based off of technical analysis. But anywho, moving on. Once you have all three added, your chart is going to look kind of like this, where I like to call them the magic lines. And it's the strategy that I use, I call S cubed, right? Super simple strategy. It's something that you can pick up the basics of in a relatively short period of time. And then you can expand upon that by adding more as your learning grows. But this allows you to understand the general way the market moves. Oh, I have a ping. Oh, am I bringing up? Am I good?
You're good for me.
Okay. Austin just has a bad connection, I guess.
Yes, it's always the YouTubers that have all the technical problems.
Oh yeah, yeah, of course. Um, but anywho, so back on track here. So yeah, the this essentially allows you to see how the markets move, and I'm going to kind of go over that here, so you can see why I use these magic lines and why they are so powerful. They do a little dance. I actually picture the candlestick up and downs like an orbit almost, and it will orbit around these lines. Blue is the weakest line. So we got our blue here. That is the weakest line. Orange is a medium strength line, and pink is the strongest. And these lines will act as moving dynamic support and resistances. Support means if the candles are above it, it will try to bounce off it. It'll kind of support it and lift it back up. If it is beneath the lines, it will be resistance. It will resist an attempt for it to get back above it. Now, if you were to like hide these indicators and just look at the chart, you'd see the candles just going up and down with no rhyme or reason. But you add these indicators, look, it's bouncing off the line. It falls under the line, which means it's probably going to head back down soon. Then it starts heading down. It tries to go back up, and people are like, oh, it's going up. Buy, buy, buy. But using our technical analysis, we will know not to buy until we've received confirmation. And I'll go over what confirmation is here in a minute. So we know not to buy here. And it keeps going down, and they lose their butt on their trade. Clearly. Confirmation is when you have a candle that opens above and closes above a point of resistance. I'm going to show that here. So you see right here, let me bring out my pointer. See right here where the candles are coming up, and coming up. They get above the blue resistance. They open and close above it. Great. There is no open and close above the orange here, which means it's about to fail. So if you were in a trade from here, you need to get out, right? Because it is getting rejected by this resistance, which we see quite clearly here. Tries to get above. Okay, you have a candle. This one opens above the blue, but it doesn't open above the orange here. You get one here that opens and closes above it. Okay, great. So you could enter a trade. You would place your stop loss under support, which would be here, and let it ride. And off it goes. Um, so if
Real
you,
quick, real quick
yeah,
before we move on, we had a question. Uh, says, my brain missed it. Which indicator is it that you're using? The three of the lines.
Yeah, so if you go to insert indicators, and you can do this on TradingView, you can do it on Dex Screener, Dex Tools, wherever. It's called a simple moving average. And you're going to make three of them. One of them you're going to set to period 50, make it blue. The second one, you're going to set to period 100, make it orange. Third one, you're going to set to period 200 and make it pink. No shift, simple MA, apply to close. And if you hear someone talking about EMAs, those are exponential moving averages. Exponential moving averages are best used on short time frames. Simple moving averages are best used on anything M30 and above. So if we go to like H1, which it means each candle is comprised of a full hour's worth of movement. H4, each candle is 4 hours of movement. Daily, each candle is comprised of a full day's worth of movement. Weekly, monthly. So any of those higher time frames from M30 up is what you will utilize simple moving averages on. And I personally will not trade on anything under M30. I generally spend most of my time on the H4 chart and on the daily chart. And that's where I'll do most of my analysis. And then let's say we're here, right? And I see, okay, Bitcoin is trending downwards. It's getting close to the MA 200. I'm going to look for an entry position in this area. So that is 726 on the date. So let's say I'm looking on the H4 chart, and I see that it's getting close to this area, but I want to get like a perfect position, right? Or as close to perfect as possible. I'll switch down to M30, and then I will go to the 26th, which is somewhere. Give me a second. Let me find it. There we go. All right. And I want a perfect entry point that's been confirmed. Zoom in so we can see it a little bit better. All right. So this is that dip that hit the MA 200, which was pink on the H4 chart. This was that dip right here. So then I switched down to the M30 and I'm like, okay, I see it's coming down. You know, where is the confirmation that we're going back up? Well, here it is. It's right here. There's your confirmation. It is, let's see, can I draw? No. All right. Anywho, where is? There you go. All right. So pointing at your confirmation there for you. So your confirmation's right here because you have a candle that opened and closed above the MA50 blue. So I would have been looking for my trade that I was looking to enter on the H4, and then I switched down to M30, find my perfect entry that has confirmation. So I would enter my trade here, 21,000, $21,083 essentially. And then I'd switch back to my H4 chart and I'd look for, okay, where should my exit be? And I just watch it. You know, I check, and since it's the H4 chart, you're not having to live in front of your computer, right? You check the chart, what, maybe twice a day? Because if each candle is worth 4 hours and you're trading on a larger time scale, your entry's here, right? $20,080, that region from where our entry point was, or sorry, 20,800. So you're just waiting and you let it run up. You let it run up. You watch your candles. You look for those wicks that indicate, okay, we're starting to see some selling pressure. But at this point, we're safely above the MA50. So what you could do is you put your your stop loss. Drop that red line there to indicate where I would put my stop loss. You put it underneath that support, and you let it continue until you see something on the charts that tells you it's time to get out. You can also calculate. Let's see. Okay, go to our higher time frames. Where are we trying to target? Where do we believe it's going to go? Okay, so on the daily chart, we have our buy and our close above the MA50, which means it's most likely going to test the orange. So we can wait for it to get there, or we can be more conservative. It really depends on what you're looking to do, right? But when you have profits and you see profits that you like, don't be afraid to take them, right? We can see some strained indications right here on the daily chart because you have not a lot of body movement, but you got tall wicks above and below, right? That is generally indicative that it's gonna kind of head down. It's called indecision. We saw that right here, right? And then it went down. We see it here. It's likely going to pull back down to this region before continuing to try to head up towards the orange. And we can get all of this information off these three little trend lines that we use. Now, there's a whole lot more to technical analysis. There's Fibonacci's, right? And that's a more advanced thing a lot of people use. Here's what it looks like if you draw a Fibonacci out. Um, and for drawing a Fibonacci, Fibonacci gives you levels based off of the Fibonacci sequence, right? You 23.6%, 38.2%, 50%, 61.8%, 100%. And if the chart's going down, you would draw it from the peak down to the bottom of your low. And then it gives you these percentage levels. Okay, so if it pulls back up to 23.6%, this is where our level would be. And you can see, lo and behold, there's your 23.6% where it came back up. And that's where the big money bots started taking profit because they got their 23.6% retracement from the bottom. See how that kind of starts to make sense? They trade off these Fibonacci's and they trade off the moving averages. So what they would do after they take their profits is they're going to start buying again to get it to like the 38.2%, and then they'll take their profits there. This is a Fibonacci sequence. There's plenty of really good videos out there on YouTube that go more into depth about how to trade a Fibonacci, how to use it. You can see here that this level acted as support, and it kind of sat above it for a while before coming back down. But if you combine Fibonacci's with your moving averages, not only does it tell you essentially when you can kind of expect the price to be at a certain level, but it also tells you where the levels are, and you can use the moving averages as kind of like a time indicator, right? So Bitcoin's probably going to range down a little bit, and then it's going to try again for the 23.6, which if you track where this moving average is going, it will cross in this region. Okay, so that's like the 12th, right? So assuming that it ranges in here, it will cross around there. But if it's going to just go up or crash back down, obviously that would make that null and void. But it gives you a good, like, off the hip estimate, essentially. So let's go ahead and get rid. I personally do not use the Fibonacci's. I know they're incredibly popular. A lot of people do use them, and there's nothing wrong with using them. In fact, I encourage it. As a new trader, you want to utilize your resources. Just make sure you're not throwing like 800 different indicators on your chart, because you start doing that and you're gonna, miss the music due to all the noise, I guess is a good way to put it. But um, yeah. So let me see here. Any questions?
We had one about taking profits. So, do you sell some, like maybe take half of a position off the table or a full position? What do you kind of look for when you, I know back when you said like when you see something in the charts that might indicate when you want to sell, what does that look like for you? Is there like specific patterns you look for, or how does that look?
So there are patterns, and pattern trading is a big part of what I do, right? It's not just these magic lines. I do use patterns, but patterns are determined by drawing out your trend lines, which let's draw one right now. Grab it from the lowest low and connect it to the next lowest low. There's a support trend line. You do the same thing with your local highs, connect them. And you can see, okay, Bitcoin is trading in this channel, right? Until it goes above that channel or below that channel, it is going to continue just ranging in this channel. Channels are great, right? Because you can buy when it gets lower, sell when it starts to get like, 80% near that top trend, buy if it gets near the bottom trend, et cetera. It's a great opportunity for just flipping back and forth, right? Scalp trading. Um, there's other, let me find better example. Da, 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 da. Give me 1 second. Again, I usually do this from my phone, so where are we at? Okay. This is the story of a girl. Sorry. Here is a falling wedge. So let me draw that guy out. Boop. All right. So falling wedge, or well, this one's more of a pennant here, but there's all sorts of patterns. And if you Google Forex chart patterns, it'll bring you up a whole list of different patterns and kind of how to trade them. But patterns like this, they can go either way. They can break down, but they're going to range in this constricting region, right? Your top trend line's coming down, your bottom trend line is, essentially just kind of going sideways. So that region is going to shrink and it's going to just vacillate back and forth until it builds up enough momentum to break out. Now, combining this with our moving averages, we see right here at this point, because it gets near the top of that trend line many times, right? But we see when it gets near this point, it is likely to break out because it's near the end of the pattern and we're above the moving average. So we can plop a buy down on the outside of that line and let it ride up. Conversely, if you have, and so that's how you can like use patterns with that. Let me see if I can find another example that might make a little more sense. Okay, so here's one. We have our trend line. Uh, Connect all the peaks. There we go. Oh, snapped on me. No, come back. There we go. Stay. Thank you. Again, a little hard to do from my laptop. Sorry. And then we have connect our lows. All right. Let me get rid of the lines that are in the way so we can focus on just the one. And it took away my other line. It's mean like that. There we go. All right. So what you have here is you have essentially a bearish flag, and it is or pennant. Yeah. Um, sorry, people call them all sorts of things. You got your bearish flag, your bearish pennant, wedge, blah blah blah. But essentially, you're looking at the isometric shape, right? It's a triangle in a nutshell, and triangles go one of two ways: they either go up when it breaks out, or they go down. But the number one question everyone always asks is, well, how do you know which way it's going to go, right? Is this all just guesswork? Uh, Sometimes, but not if we combine it. See our moving averages here, we know our MA200 is a strong resistance. So when we see that it is near the edge of our triangle here, the tip, and it's going to go either up or it's going to go down, how do we know which way? We look and we see, okay, zoom in a little bit, all the moving averages all connected together here at this one point because it was ranging sideways for so long, and it's beneath them. That is a huge point of convergence for all of this resistance. I wouldn't bet someone else's money that it would go up out of this. I'd be betting that it would go down because you have all this resistance, convalescing in this one area, and you're in a triangle, which means it's either going to break down abruptly or break up abruptly. You can actually calculate how far it will go down simply by measuring the mouth. So here's 26. Zach, pull up a calculator for me real quick. Let me know when you got that up, because quick maths is not my thing.
All right, got it up.
All right, take 39,837
All right.
and subtract 26,580.
All right.
What number do you get?
Get 13,257.
13,000. Sure. Yeah, well, it's approximate anyways. Um, so we know it's going to do a pretty big move down. It didn't quite go down to 13,000, but it dropped all the way from 29,000 down to 17,500, right? So you're not going to get the exact number of the move by measuring, but it gives you a good indication of how much of a move to expect. So you measure your mouth, which is the open side of where they connect, and then you subtract that from where it breaks out to get a good idea of about how far it can come down. Now, obviously, it is an open market. It may not, and that's why you heard a lot of people talking about, 14K, 12K. I know, like 2 weeks ago, you heard everyone screaming, 12K, 11K. Everyone was calling out numbers around that region, right? um, and that's because they were using technical analysis. They were measuring this, which when he subtracted that from this price, it got him 13K. Oh wait. No, you said 13,000. Okay, now take yeah, so that would be 13. That'd be like 16K. Okay. Yeah, so that sorry. I had a little brain fart there. What you do is you take the number, which was that 13,000 that you pulled from right subtracting those two numbers, then you subtract that 13,000 from the price at breakdown point. So we would take 29,493 and we'd subtract that 13,000 from it. Can you do that for me, Zach?
Yes, I can.
Lifesaver.
Oh yeah, that's what I'm here for. So that's about 16,200.
Okay. And it dropped pretty close to that. It was what, 1,200 bucks off?
Yep.
That's not bad. That's pretty accurate right there. There's always going to be wiggle room, right? I like to assume that there's going to be anywhere from a 10 to 20% wiggle room, on pattern calculations. A lot of people, they try to do it exact, but remember, we're not trying to time the exact bottom. We're not trying to time the exact top, because doing that will leave you either A, missing out, or B, holding a bag, right? Neither of which you want to have happen. So that gave us a pretty good approximation of where we should look to stop shorting. So, like, if you entered in a short after it broke down out of this triangle, okay, calculations are pointing it at 16,200. Let me dial back a little bit to make sure I'm not left holding my short position when it starts going back up. So we'll target, like 17.8. I like to pull it back by a percentage, because I'm not trying to get out at the bottom. I'm trying to get out with money. You're not trying to get out at the top. You're trying to get out with money. That is the whole point of why we are here. We're not here to hold someone else's profits. And what I mean by that is, if you don't take your profits, you're going to be someone else's profits. So just be aware of that. Keep that in mind. And don't try to aim for the tops, and don't try to aim for the bottoms. But
Yeah,
yeah,
we got a follow up question from Salarai. He asks, he didn't quite understand how exactly those lows and heights. I think when you're drawing those trend lines, he didn't quite understand how exactly you chose those ones in particular.
gotcha. Okay, so what I do is I take the local low, because the way the charts move is every so often they'll create a new pattern, and I go based off of that. So what I mean is, let's see, and this will become more second nature the more you look at charts, right? So you saw how I kind of grabbed from right here when I first was drawing for you, and I was drawing a trend line coming down, and then showing how it pops up. Uh, I took the local top and connected it with the tops after. I took the local low, connected it with the lows after. You could technically say, okay, here is the tippity tippity top, and I'm going to draw a trend line from there. It all depends on what time frame you're trying to look at, right? You can draw, if you're trying to do a long-term trend, you can draw it out all the way as far as you want to go. But if you're looking at trading, today or tomorrow or sometime this week, you would grab it from the local. So this is the H4 chart. So I don't have to go super far back in time, right? I drew it from here. Uh, Let me delete this long one. There we go. That we're not confused. I drew it from here, because this is the local top. Yes, this could technically have counted, but I know that this is a micro pattern right here, right? There's a little tiny triangle right there, so I ignored it. I went from the next local top and drew it down, connecting it with all the other tops that lined up in the process. Did the same thing for the low here. I took the local low, connected it with all the lows, and it gave me this nice little triangle right here. So, like, if I was to switch to a random chart, let's switch to gold. Let me delete all these lines from my last lesson. Hold on. A few seconds. All right. So let's say I'm looking at this, and this is the daily chart. Okay, cool. That's pretty long term. So let's switch to like the H1, because I'm looking to find something now. Okay. So I see right here, local high, connect it down. Why does it snap my... No, this one. Thank you. All right. Um, and again, you'll get better at spotting these locals the more you do it. So I could see, okay, this right here is what's known as a bullish pennant or a bullish flag, sorry, because you have your flagpole right before it, which is where the chart's like going up, 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 up really sharply. And then it forms into this triangle right here that's kind of coming down a little bit. That is a bullish flag. So when it breaks past that, we know that we can measure. Okay, we have, and you got your calculator, Zach? Take
Get it back out. Yep.
take 1,739,
All right.
subtract 1,713.
All right.
Now add that number to 1,722.
You get 1,748.
1,748 would have you taking profit right here. Is that the top? No. Is that good money? Absolutely. Just as an example, if you had so 722.48, that is a total in the forex market of 6,000 yeah, 6,600 pips. Oh wait, no, sorry. Brain stopped working. 2 seconds. Or 68 or 48. That's where I messed up. Sorry. Okay.
Good.
Yeah, that's a total of 2,600 pips. Which, if you are trading that, let's say, okay, uh, you got 2,600 pips. If you are trading that, with a 0.05 lot, that's 5x leverage. So you take times 5. It's 130 bucks right there for you. So it's a $26 movement on the chart, right? Because it was 1748 to 1722. But you get 130 bucks off it, right? And that's fine. You're not trying to catch the whole thing, right? You want to capture your calculated exit point. But yeah, to answer your question, I guess in a more simple manner, um, I'm grabbing local patterns and drawing them out with the trend lines. I could try to draw it with this one right here. Let me delete these trend lines to show you what that looks like. It does matter where you draw them, but worst case scenario, you'll get a similar result, right? This is kind of like a messed up cup and handle, which you calculate by taking the local bottom, subtracting it from the lip line here, and then adding that to this. Again, that's patterns, which is a whole nother a whole nother workshop. And I know we're running short on time now, but I grab it from the local. Right. If I see a spot where it starts ranging, or I see an area where it's forming some kind of pattern, I'll draw my trend lines there. So as you look into patterns and look into learning them, you're able to kind of draw your trend lines. A lot of people, quick and dirty, will draw it horizontal trend lines, which you can do by finding things like this. See where the chart keeps coming down. That's a horizontal trend line. You draw it across like where all the bottoms are, and so you know that that'll be a point of resistance when we get back up there. You can draw another horizontal trend line. Um, let's say, where is it? Where is it? Where is it? Yeah, right here in this region. So it was a resistance back here, support over here, and then it broke, right? And that's why you saw, like, when we switched over to this chart, you saw a bunch of horizontal lines. I was showing them how to draw horizontal trend lines, or not trend lines, horizontal supports and resistances. That's a quick and dirty way to find like flat support and resistances, and it may be better to practice with that in the beginning. But as you get better at looking at the charts, you can grab your local top, draw your trend lines down, where all the peaks connect. Peaks connect. um, Same thing with your low. Grab your local low, draw your trend line. We see that it was in a broadening descending wedge, but now it's above it. That's a great bullish sign. Plus, we're above all of our moving averages. If it gets too far away from the moving averages, it'll come back down and touch them. We, we see that on any chart we look at. If it gets too far away, whether it's beneath it or above it, it will try to get back above them. And then if it's above them too far, it'll come back down to touch them because they're like gravity. It's it's a lot of information to try to cram into about an hour, and there's so many different things that you can learn about technical analysis. And a lot of people, they're like, oh, trying to trade the market is like gambling. Kind of, yeah, sure, but it's educated gambling where you can tilt. The house doesn't always have to have, you know, the edge, right? You can tilt the edge in your favor just by knowing how to read the patterns and knowing how to, look at your moving averages, how the chart's going to interact with it. You don't spend a whole lot of time on your minute chart, right? Big movements like that are scary, causes a lot of emotions. Focused on H1, H4, you're going to learn more about the fluidity of how the market moves, and that's your goal. Watch the chart, learn how it moves, have your moving averages in there to kind of explain the why does the chart stop there. I'm going to show you. You see how it all just kind of, you can see, okay, we went up here because we bounced off this. Then we went to touch this. Then we bounced up, touch, touch. It's more like it makes more sense as to why it turned around and went up, or why it turned around and went down when you have these lines. But I'm going to go ahead and delete those lines. And this is the chart a lot of people look at when they're starting out. And it looks like there's no rhyme or reason to any of it, right? So having those lines helps give some of that rhyme or reason. Now, some people may find it easier to practice drawing trend lines without the indicators. And I'll give an example of that. Okay. There's a trend line right there. There's a trend line right there. You can draw a little trend line here. You can draw one here, because you can draw a trend line technically off any two peaks and two lows. As long as you have two peaks and two lows, you can draw a trend line, which is why a lot of people's charts wind up looking something like this. And this is going to make me cry internally, but I'm going to show you. Don't fall in to the spaghetti trap. Um, but this is something that some people do, and they will actually trade like this. It's if it works for them, great. But you wind up with this much information on your chart, and again, you can miss the music for the noise. Um, you know, so the whole point of technical analysis is learning to read the charts and trading in your own style. Find what works right for you. Utilize the information that the bots and the algorithms and the big money are using to trade, whether it is their what's the word? Their moving averages or their Fibonacci sequences. Just utilize that information and then find a method of trading it that works for you.
Yeah, I think that's
'Cause
all very good stuff. So, like you said, a lot of information jam packed in a little bit over an hour. So I think we'll go kind of like start wrapping it up a little bit. If any of you guys have questions, feel free to drop them in the chat. We did have one from Austin. He asks, "Do you only trade Bitcoin?" My biggest question is, how do traders select their pairs? He sees trading videos and traders trade all these different pairs, and I'm always wondering how they select those pairs specifically compared to others.
Yeah, that's actually a really good question. So the reason why I trade Bitcoin, Ethereum, and gold is because they have deep liquidity and they are all paired to the US dollar. Same thing with the Dow, US 30. I'll trade the Dow as well. And you can see trend line from my last video, which was over a month ago. The trend lines are still holding true, right? Um, but I trade those because they're paired to the US dollar, which means there's only one external factor outside of their own news that affects their chart. You know, if the US dollar is skyrocketing for some reason, they will come down. If the US dollar is going down really hard for some reason, they will go up, right? Of course, they have their own news as well, but I only focus on 3 or 4 pairs at any point in time because trying to keep up with information and news with, 15, 20 different pairs that you're trading becomes a lot of work. So traders will tend to gravitate towards their favorite pairs, ones that they've done well with in the past because it has a predictable nature to it. Like I love gold, okay? I can trade it in a bear market using only buys and make money, not short it, because it is predictable because it is paired to the US dollar, right? It makes all sorts of beautiful patterns like this cup and handle right here. Again, patterns, but that targeted profit here, right? So it's very easy to trade and to learn to trade on things like gold. Um, Bitcoin, not so much because of the higher rate of volatility. Like gold, for instance, if you have like 2,000 in your account or something like that, you can actually use a lot size that is safe enough that even if you enter at the wrong point in time, you can actually just leave that trade in until eventually it comes back into profit at no risk to your account because gold does not move as much. Um, Now, I highly recommend if you do start doing any kind of trading on MetaTrader that you utilize a demo account first. For the purpose of this demonstration, I just signed into a demo account um, just to, in case we were doing any like example buys and sells or whatnot. But we did not get to that today, which is okay. But um, yeah, so those are my favorite pairs because they're paired to the dollar. They're very predictable long term because they respect the patterns um, and they follow them quite nicely. So I know that's not. Oh, where did Bitcoin go? There it is. Um, but yeah, so they're predictable. They're easy to chart out, and so they're great for people who are starting out with practicing the charting. If you're starting out trading, learn on gold. I guess is the best way that I could put it. Which the forex symbol for that is XAU USD. But yeah,
Perfect. So, if any of you guys have any other questions, go ahead and drop them in the chat. Do you have anything, any concluding words you'd like to say? Maybe like a word of caution or anything along
yeah,
those lines?
yeah, absolutely. Before attempting to do any real trades on your live account, make sure you understand what you're doing. Make sure you understand what you are doing because any kind of leverage based trading or forex trading or any trading in general, if you don't understand fully what you're doing and how it all works, you will lose your account. When the very first time I picked up forex trading and I was trading Bitcoin, I lost my entire account. Right, I managed to get it up, a decent amount, And then I didn't understand risk management. And so then I lost it all, right? And this was many, many moons ago, but it's a lesson I never forgot. And losses are not, they're not something to be afraid of. They're a natural part of things. And it's your job to understand that a loss will occur at some point, but how can I manage that risk, manage the loss to make sure it doesn't do significant damage to me? And that's all in risk management, which I can make a whole other video about that. Have a whole other workshop on risk management. But there's plenty of good resources online um, about that. So I'm not gonna get too deep into that right now. But I recommend, if you are interested in getting into the forex style trading or leverage trading, that you have a demo account, you triple it, delete it, make another one, triple it, delete it, a third one, triple it, and delete it. Because by the time you have done that 3 times, you should have built up the patience and the discipline and the good habits necessary to then do it again for real. And on your live account with real money, because at that point it's ingrained into you. Okay, I know the steps to take. I've been here before. I've built $1,000 or $3,000 account up to like 9,000, and the purpose of the deleting the demo account is to simulate paying yourself. You triple something up, you take out that 2x, you put it back in your bank account, and then you triple up your starting amount again, right? You've got to make sure you are paying yourself, because the more money that is in the account, the more risk you're exposing yourself to, and the more money you could potentially lose if you're not using proper risk management. So build up those good habits through practice, through discipline and patience. And if you can do that and you can keep your emotions out of it, you can be a successful trader. There's a whole bunch about the trading mindset that's important. It's like, if you a little snippet, and then we'll wrap this up. If you suffer a big loss, stop trading. Don't trade again for the rest of the day, because subconsciously you're going to be like, okay, I just had a big loss. This owes me my money back. I'm going to get it back. And you start revenge trading, and you make bad decisions when you are emotionally involved. Conversely, if you have a nice big win where you got more than you expected and you're like, hell yeah, let's go, stop trading, because you do not make good decisions when you have just had a big win. That is why the casinos are okay with you winning big, because you're going to stay there and keep gambling, and eventually the money will come back to them. Same thing in the markets. If you have a big win and you don't step away from it and then come back later with fresh eyes, you're going to keep trading, and the money will go back to the market. Okay. I have a percentage that I aim for each day. I'm like, okay, if I, compound my account by 2% today or by 5% today, I'm done for the day. I'll come back tomorrow and do it again, or I'll catch the next trade, that presents itself a couple days from now, and do it again. You want to be consistent. You don't want to sit there and be trading off your emotions. So I guess that would be the final little word of caution that I would leave for you. If you have a big loss, stop trading for the day. If you have a big win, stop trading for the day.
I
But
like it.
yeah,
Yeah, that's definitely a much needed word of caution. It's a risky game for sure, and emotions will get the best of people more often than not. But
yep,
yeah, Cyril, thank you so much for taking the time to enlighten us with the technical and analysis workshop today. This was super fun and informative. And for those of you guys listening in the audience, let us know what you thought. I think it went really well. But if any of you guys have any thoughts or suggestions for next time, we're super open ears. Would love to improve as we go.
Yeah, absolutely. And thank you guys for, for coming out and giving a listen. And again, it's a lot of information to try to cram into a single hour session. And I know that 9 times out of 10, that first video leaves you with more questions than it did answers, right? But you know where to find me. And I do have other educational resources. I have videos on my YouTube channel that goes over a little bit more in depth into different aspects. You'll have to forgive me. I am no Austin Clark video editor extraordinaire by any stretch of the imagination. My videos are very grassroots, but there is information there to be had, and so feel free to give it a listen if you want more, or reach out to me if you want to learn more.